will do a short introduction and we will just continue on with the conference. So I'm particularly excited about this next session. The racial wealth gap is one of the important issues of our time. And here to talk to us today is Lowell Ricketts, the lead analyst for the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. Lowell conducts research and policy analysis on household balance sheet issues. His research covers topics including the racial wealth divide, growth in consumer debt, and the uneven financial returns on college educations. His work has been featured in the New York Times, the Washington Post, the Wall Street Journal, and CNN Money, among other publications. Lowell, thank you for being here today. We very much appreciate it.
Thank you, Jennifer, and thank you for everyone, a part of NAEE. How do I pronounce that, Jennifer? NAEE?
NAEE, but that's good.
NAEE, okay. Well, it's a pleasure to be with you today on this Friday. Thank you for giving me an opportunity to share some of our work. I saw a few of my St. Louis Fed colleagues, as well as system colleagues as well. So I'd like to say hello to everyone out there. Today, I'm going to be talking about the racial wealth gap, some of the historical roots in forming these gaps, and the systemic barriers to closing them. I'm Lowell Ricketts, as Jennifer mentioned, the lead analyst at our Center for Household Financial Stability. So what do? We study household balance sheets. And for those of you that may not be familiar with this terminology, it's really what households own, what they owe, and what they earn. That's sometimes how we characterize it. Before I begin, I should state that these are my own views and not necessarily those of the Federal Reserve Bank of St. Louis, the system, Chair Powell, or anyone else. All right, with that, let's begin. So here's an executive summary of my remarks today. What we're seeing right now during the pandemic is that Black and Hispanic families are experiencing the worst housing distress, some of the worst food insecurity. Along many dimensions, we're seeing these families suffering significant financial instability. But many of these inequities existed well before the pandemic. A lack of assets or net worth or wealth has been linked to a greater risk of hardship in some of the work done by our center and the visiting scholars that are part of our center. So thus, this lack of assets and the long-running and persistent racial wealth gap is contributing to some of the chronic fragility across these many different outcomes, as well as not only the instability, but a lack of upward mobility and sometimes a greater share of downward mobility that you may have seen in work by Raj Chetty and others. Racial wealth gaps have long and deep historical roots. I'm going to be talking about one example of them, which was the practice of redlining, but it's not the exclusive example. There are many others which we won't have time to go into today, but also systemic barriers to closing them, which are maybe not so much born out of explicit discrimination, but really the inequities that exist and continue to perpetuate themselves. Lastly, I'm going to give you a policy framework to think about how we might go about closing these racial wealth gaps. And really the framework suggests that evidence for bold policy is thin, given that the scale of the interventions are quite large and oftentimes lie outside the scope of research. But this shouldn't preclude consideration if we want to be really serious about closing these persistent gaps. So with that, I'm going to jump in and just kind of set the stage, because you may wonder, why do assets and wealth matter? And sometimes wealth is used as a term for income. But what we have found repeatedly in work, not just our work, but a body of literature, is that assets and net worth uniquely matter. And accumulated wealth can be thought of as central for both the economic resiliency, avoiding the many forms of instability that I just outlined, but also is key to that long-term upward mobility. The center director, Ray Bashara, put it eloquently when he was contrasting income and assets, saying that a lack of income means you don't get by, but a lack of assets means you don't get ahead. And I think that really summarizes the unique role of balance sheets in predicting so much of upward mobility and short-term stability. And it's specifically liquid assets or emergency funds has been found and can be thought of as a private insurance for events such as an income shock, which you're all familiar with the numbers, the unemployment insurance claims, and the historic levels of job loss that we've seen in this crisis. And liquid assets appear to be the salient factor in reducing a risk of instability, such as a missed housing payment or delinquency more generally. And here are two works that our center and center scholars have put out. So, our center, one of the keystone publications is what we call the Demographics of Wealth. And this is an essay series that really disaggregates outcomes by demographic factors: your race and ethnicity, your education, that of your household, but even that of your parents, capturing some of the intergenerational linkages of education and wealth transmission. But also age and birth year, your generation, whether that be millennials or Gen X. All these factors appear to be strong predictors of adult financial outcomes, whether that be wealth accumulation or episodes of delinquency and many other features. I want to give a plug because this series is based heavily on the Federal Reserve Board's Survey of Consumer Finances, often considered the gold standard of household balance sheet information. And we're very excited. In the next few weeks, the 2019 survey data will come out. And that matters a lot because it comes out every 3 years. So almost as frequent as the Olympics. And so we're equally excited to start working with the new data and publish our next series early in 2021. So stay tuned. So let's look at Black and Hispanic income relative to white incomes. What I'm going to be showing to you here is median real income. So we're choosing the median, which is the middle of the distribution, rather than the average, which you may hear often. And why do we do that? Well, given how skewed financial outcomes are in the US, oftentimes the median gives more of a characteristic or typical experience. So we find that to be incredibly important to look at those statistics rather than averages. What you see here is data going from 2016, the latest observation. As I said, we're very excited about 2019 data coming out, but going back to 1989, which is really the first modern wave or contemporary wave of the Survey of Consumer Finances. What you see here is in the black line at 100, you see the median outcome among white families. And in the green and red lines, you see the median outcome among Hispanic of any race families, as well as Black families. What is this purple line? It's other races, and this unfortunately is an aggregation. It's all of the other races and ethnicities included in the Survey of Consumer Finances. Due to confidentiality constraints, they can't disaggregate further. So it leaves us with many questions, given that this appears to be quite strong, actually better than white outcomes. But what you see over this time period is that incomes have converged, albeit slowly, to the white levels. And most recently in 2016, Black and Hispanic families are roughly 40% lower than white families. But this is a very different picture than what we see with wealth gaps. Up top in the blue line is the actual outcome, the median outcome among white families. At the bottom in orange is the median outcome among Black families. And you can see that despite other progress in civic representation, educational attainment, and progress in the labor market representation, these large racial and ethnic wealth gaps remain essentially unchanged. And that typically white families had about 10 times the wealth of a typical Black family. And you can think of this differently as Black families. The typical Black family had 10 cents to the dollar of their white peer. So pretty stark gaps. And if you trace this even further back, scholars, two German scholars, Moritz Schulerich and Moritz Kuhn, have taken the predecessors to the contemporary wave of this data set and traced a large and persistent wealth gap all the way to the 1940s, which, given some of the historical roots of these gaps, it's not too surprising. But I want to draw your attention to this middle line, the purple line. And what this represents is actually the 75th percentile of wealth among Black families. But even wealthier Black families fall short of white medians. And this will give you a sense of how starkly different these wealth distributions are by race. And among Hispanic families, we see very similar gaps. And if you were to split up all the wealth, the household wealth in America, white families in 2016 owned 89% of it, while Black and Hispanic families owned 3% each. And that's less than their share of households within the overall household population. So stark gaps and stark wealth inequality by race and ethnicity. So I want to dive into an intersection of these demographic factors. We know that any one family is not just Black or white, or not just a college grad or non-college grad. The intersection of these factors is incredibly important. And what we find is, importantly, a college degree is associated with greater median wealth for all groups. And let me belabor this point. We're saying that if you compare the columns on the left, which is for non-college grad families by race and ethnicity, and the columns on the right, which is families that have at least achieved a four-year degree, you'll see that the typical wealth outcomes are greater. But you'll also notice that the racial wealth gap does not disappear even among college-educated families. You can disaggregate this even more granularly and look at postgraduate families, those with MDs, PhDs, MBAs, and the gaps will remain. They close a little bit among the college-educated peers. The Black-white gap is 17 cents per dollar, but that's certainly something to be satisfied, or certainly not something to be satisfied with. And we can continue to dig into more work that we've done in this space, but I think we'd get off track from the real question, which is what explains a racial wealth gap? So two board economists took the survey of consumer finances, actually the non-public version, so it had many more factors that were contained within it due to confidentiality concerns. And they found that observable factors accounted for almost all of the white Hispanic gap in wealth, but most of the gap between white and Black families. But still a substantial unexplained portion remained for the white-Black gap. And so by observable factors, education was included, family structure, occupation, geography, home ownership, income. Really, I like to call this everything in the kitchen sink, meant to try to find what observable factors were most associated with the racial wealth gap. But they make an important concession early on in the paper. They see that some of these key factors that account for the wealth gap, including income and home ownership, could reflect themselves the effects of racial biases as well. So these factors are not independent of race and ethnicity. So race and ethnicity, the lived experience, the historical experience, and structural factors associated with that continue to influence the observable factors. So it's difficult to draw firm conclusions that any tweak to one of these outcomes, such as home ownership or income, would be able to close the gap, because they're not independent of race and ethnicity. So this prompted our chief economist, Bill Emmons, and I to present an alternative theoretical framework that borrows from sociology, that attributed racial differences in observables to systematic or structural factors in the past and present. And a comparison of these frameworks, the one used by Thompson and Suarez may be more typical in what you see in linear modeling and economics, provides suggestive evidence that these gaps for both Black and Hispanic to white wealth gaps may lie beyond the scope of any individual action by a family or a marginal policy change to tweak one of these important variables, such as home ownership or income. Instead, these gaps appear to be deeply rooted in unobservable factors outside of our data set that may include discrimination, but other long-lasting disadvantages that can't be directly observed in the contemporary data. So let me give you an example of the long-lasting disadvantage, because I think it's so important to delve into the history of systematic exclusion of asset accumulation in the US to really understand what we're talking about. And this is the practice of redlining. So for those of you that might not be familiar, in the wake of the Great Depression and the substantial insecurity and instability in housing markets, the federal government really stepped up its involvement in housing markets in the US. One feature of this was the Homeowners Loan Corporation, or HOLC, was created in 1933. And they were tasked with creating maps for over 200 cities to grade, with A being the least, D being the most risky, the riskiness of lending to entire neighborhoods. So you might find common factors that are still used in lending risk decisions and appraisals, but also racial and ethnic makeup was included. And so a C-rated neighborhood by the HOLC map guidelines were deemed to have, quote, an infiltration of a lower grade population. These are directly verbatim from the assessment forms. At the same time, FHA made parallel maps that were equally candid about what they were looking at, with, quote, an undesirable racial or nationality groups. Thus, those neighborhoods rated D, or deemed to have the highest risk, were drawn in red. Consequently, this is where redlining comes from. And borrowers in these neighborhoods were denied credit based on their racial composition. So here's a HOLC map. These were recently digitized by the Digital Scholarship Lab at the University of Richmond. You can access maps for your own area. I know we have a diverse geographic distribution of attendees today. This is HOLC maps from the St. Louis region. And if you're familiar with St. Louis, as I am, it doesn't take long for the eye to draw out the correlations between red-lined and yellow-lined neighborhoods and the history of disinvestment in our region. But we can do better than correlations. 3 Chicago Fed economists, Daniel Aronson, Daniel Hartley, and Bosch Mazumder, sought to take these redlining maps that were recently digitized and understand the actual causal relationship that they had with investment and other outcomes in neighborhoods over time. They found that they affected the degree of racial segregation. Areas that were redlined became more heavily Black than nearby C-rated areas. Importantly, they also had meaningful negative effects on homeownership rates, house values, rents, and vacancy rates, many of the benchmarks and metrics of our housing markets and commercial real estate. And they rose steadily from 1930 until about 1970 or 1980 before declining thereafter. And I want to really press upon this point, because I think when we think about the civil rights legislation that outlawed redlining practices and other explicit forms of housing market discrimination, we think that the effects hopefully would have faded quickly thereafter. But this suggests otherwise. This suggests that all the way into more recent memory, these redlining maps echoed to the present families in these neighborhoods. The maps could account for 15 to 30% of the red to yellow line DC neighborhood differences in segregation and homeownership rates, and importantly, 40% of the gap in house values between 1950 to 1980. And for many of these families, many families in general, a house is one of the largest assets, is the largest asset. And so you can see here how homeowners of color in these neighborhoods that had attained this dream of homeownership saw the values of those homes artificially suppressed over the late 20th century. But it's not only explicit discrimination that continues to undermine Black and, pardon my omission, Hispanic homeownership here. 3 Fed colleagues, system colleagues, looked at the prevalence of contract for deed financing in communities of color. And if you're not familiar, these go by many names. They're a far riskier financing product than a traditional mortgage, and often are used when the value of a home is not high enough to attract a traditional mortgage, or the down payment available offered by the family is not enough, and so they have to go to alternative financing, or credit may be a consideration. And these contract for deeds place all the maintenance requirements that you would have as a homeowner upon the borrower, but if they're ever delinquent, they instantly can be foreclosed upon and exited from the home, despite investing ample amounts of money and time in repairs, as well as whatever accumulated equity they had. So this is a byproduct, not so much of explicit discrimination, although in some cases these are predatory practices, but also just the depressed wealth accumulation of the borrowers, as well as the depressed home values that have been influenced by some of the redlining practices and disinvestment over time. Now, Junia Howell and Elizabeth Corver-Glenn also outlined how the appraisal process is often non-standard and features a subjective selection of neighborhood comps, which can lead to some racial identities of neighborhoods or perceptions of racial identities factoring into some of the decision making. Or again, due to disinvestment in some of these markets, there just are a lack of neighborhood comps, leading to appraisal gaps, the likes of which here in North St. Louis City we have seen. And pardon my dog, he is a good guard dog, but he will interrupt us at times. And lastly, taking a more macro perspective of homeownership, this was work done by Stephen Ross and colleagues, and they found that homeowners of color had entered late into the housing market in large numbers, precisely at the time when asset prices were most inflated. And some of this entry, of course, was predatory in nature with exotic loan products. And that, coupled with the labor market vulnerability, which is yet another systemic factor which really inhibits our communities of color from full participation, led to greater foreclosure rates. A presentation by our chief economist, Bill Emmons, and I on Wednesday, our Dialogue with the Fed series, really highlighted that Black and Hispanic homeownership has not recovered nearly any of the gains that it made in the run-up to the housing crisis. And just recently, looking at household pulse survey data offered by the Census Bureau, as of late August, we saw disproportionate rates of housing distress, defined as falling behind on mortgage payments, among Black and Hispanic families, echoing and raising alarm bells of the last downturn. So what do we do about this? I don't have a specific policy proposal. At the Federal Reserve, we can't advocate for any such specific policy. But Michelle Jackson, a sociologist at Stanford University, offered a wonderful way to think about policies that in the context of this publication, she was looking at eradicating poverty and closing income gaps. But I think it dovetails quite nicely with thinking about how do we close the racial wealth gap? And it really contrasts these two conversations. Conversation one outlines an expedient, small-scale interventions aimed to solve tightly defined problems or improve upon existing institutions. Whereas conversation two involves a deeper discussion about where these wealth gaps come from, the likes of which we're having today, and what larger scale changes might be able to close them. Recall how persistent and powerful, even conditioning on all these other factors, these wealth gaps remain. So I don't want to impress upon you that one conversation is more important than another. Both are necessary, but often in social sciences, the first is preferred or crowds out, precisely because we can design randomized controlled trials and other studies to evaluate their effectiveness and be confident that they can achieve their result. Whereas in conversation two, these are more fundamental changes to society, which the scale of which suggests they might be able to really impact these wealth gaps. But there's no way we can design a randomized control trial or natural experiment to really understand how they might play out with great clarity. So I want to give you an example of this. So conversation one, I wanted to highlight the efforts of Bank On. And again, I'm not trying to criticize these efforts. I think they're very important as well. And Bank On seeks to solve this tightly defined problem. By their measure, close to 7% of US households are unbanked, so they lack a checking or savings account, whereas about 20% of US households are underbanked, meaning they still use some fringe financial services such as payday lending, which can be very costly over time. Now, Bank On focuses on providing an industry standard for safe and appropriate accounts for this population, particularly those without overdraft fees. And these accounts can help families to avoid using expensive alternative services and paying too much for just basic financial transactions. And so this is a great program. It's defined, it's a clear definition of the population in need. It provides a tightly defined solution. But if you were to ask me, will this be able to close those racial wealth gaps? I'd be very pessimistic given how resistant they are to so many other marginal policy tweaks. Now, that's not to say that Bank On can't help people. And I think that's the tension between Conversation 1's conclusions and Conversation 2. Conversation 1 seeks to help individual families achieve their dreams, achieve a better life. And that is, of course, a noble pursuit. Conversation 2 seeks to change societal outcomes. So clearly both, there's a capacity for both, and leading to societal outcomes requires changing many families' outcomes. But I think it's the scale, again, that is contrasted here. Conversation 2, and again, I'm not endorsing any specific policy. I just want to give you ideas for bold changes in society. And I'm not going to provide a roadmap, and I understand that might be frustrating. But what if we renewed our pursuit of desegregation of our primary and secondary schools? What if we disassociated school funding from neighborhood wealth? I think there's ample models in Europe where there isn't such a negative feedback loop, where neighborhood exits and neighborhood wealth outcomes being depressed doesn't automatically starve the institution, such as a primary school, of the resources it needs to serve its population. What if we ended residential segregation by both race and income? As we've seen too much in the housing market, a deep history of segregation by policy, explicit policy, has led to the outcomes today. But as Junia Howell and Elizabeth Corbett-Glenn outlined, it's now just the stratification alone that can persist. What if we provided universal higher education with a race-conscious lens? And lastly, what if we endeavored to do more forms of wealth taxation? And as someone that really studies balance sheets and wealth outcomes and wealth assessment in great detail, I know the challenges of carrying out an effective wealth tax, especially when assigning value to exotic assets that are found strictly on the upper end of the wealth distribution. So I present to you all of these ideas as just bold changes to our society. And the reason that perhaps these get crowded out is because we spend so much energy, political and research-based, to pursue Conversation 1 outcomes, that perhaps it precludes Conversation 2's outcomes, which would require a much greater magnitude lift in our society. So with that, I would encourage you to connect with us. We're going to have a flurry of publications as we receive the new SCF data. We're going to have another publication leveraging something called the distributional financial accounts, which will provide some glimpses of wealth outcomes during the pandemic. So there's going to be a lot of content. Feel free to join our newsletter. I also have included in my slides, which I'll make available, I think Jennifer will be able to circulate these and we'll have them on our website, all of the resources that I've drawn on here, research by our center and research by across the system and elsewhere, and you can find all of this through the hyperlinks. So I'm sure this has given you a lot of food for thought, and so I'm looking forward to the Q&A. So why don't we jump into that?
Awesome, thanks, Lowell. Yeah, it's fascinating, enlightening, and a little bit horrifying, overwhelming too. So we still have about 10, 13 minutes for questions. So if you want to pop them in the chat, or that's probably the most efficient way to do it, to pop them in the chat. There's one question from Kim Holder. Along with your questions of what if school funding followed the student and they could then choose where to attend?
This is a great idea, and perhaps a differentiation with some 529 accounts offered at the state level, which limit some of your options. Now, I will reference, and I should have referenced in my slides, the baby bond proposal made popular by Derek Hamilton and Sandy Darity, championed by Senator Cory Booker. And this is an idea where it's an endowment at birth for all children born, or sometimes when they go into kindergarten, it's an asset endowment. Here are funds and ways to kind of build these funds over time. They're also known as child development accounts, and they're a particular research area of the Washington University in St. Louis, the Center for Social Development. And so the idea is these funds will not only be a portable asset source for investing in education, but it could be home ownership, it could be a small business, a lot of kind of the individual investment accounts. So that's somewhat of a form. I think it's more higher education, but perhaps you could go from the primary school funding model at the state level and offer a little bit more stability for our local schools. And I see we have a recommendation for The Color of Law, a great book. For anyone interested, there's also The Color of Wealth by Marisa Baradaran, and The Broken Heart of America by Walter Johnson, which really highlights some of the tumultuous history of race and exclusion in America. And of course, I'll reference Melvin Oliver and Tom Shapiro's Black Wealth, White Wealth as another great resource. This is from the 90s. They were talking about state-sponsored asset discrimination well before many others. And so I've built much of my work on their thinking as well. So another question, would universal higher education deplete the benefit to a college degree? As more people get a degree, there's an increase in the supply of labor with degrees and a subsequent decrease in wages. I'd like to think that higher ed would increase productivity. I think what we've seen, the evidence is that there's a huge appetite for college grads, and some of the higher education, I think it's understood, and some of the press for universal higher education suggests that there is still unsatiated demand from employers for university graduates. So I'm pretty optimistic that we could pump out far more graduates and still achieve the same returns in the labor market. That being said, I think it would resolve some of the inequities we see in higher education. Some of the work that I didn't show here because we didn't have time is just how college and higher education and the significantly growing costs of higher ed due to disinvestment in higher education, public higher education systems in particular, especially during downturns that we find ourselves in right now, has really raised the risk for individual students and placed that on students. And so what we see when we think about some of the outcomes by race and ethnicity, we see that students of color more disproportionately have to finance higher education. And so again, even pursuing these degrees continues to inflame some of the wealth disparities that we see, because we know they're intergenerational in the context of students going to college, in which if their families either lack financial resources to help them, or these students are first generation college students, this creates significant barriers for them to completion. And as Fabian Pfeffer at the University of Michigan has found, it's really a battle for less so enrollment in higher ed, but completion of higher ed. And for so many, looking at the student debt side of things, so many students that run into delinquency and serious delinquency and default are those that were never able to attain the degree. They paid so much money out of pocket for that degree, but don't get that signaling effect in the rising wages. All right, so I would be happy, looking at Kim Holder, I'd be happy to send a short recommended reading list. What could banks do given the news this week on diversity from the banking profession? If their boards and their internal people aren't diverse, then they perhaps aren't practicing diversity in terms of lending or banking products. I think what we found at the Federal Reserve in our pursuit of greater diversity is that it matters who's at the table. It matters who's at the table at the top of your firm, all the way down to those that are interacting directly with customers. So I think we all have a long road ahead of us to continue to push forward on those diversity metrics, especially, and I'll put under lens of examination at the senior level, at the president level of our Federal Reserve System. We have one president of color, and so we could do much more at even the upper echelons of making that decision-making reflect the diversity of our constituents. Is there an example of historic economic policies that have already been implemented or potentially repealed in order to help address some of the issues related to the racial wealth gap. Well, I will point to some of the CRA and its efforts to make credit available in low to moderate income communities. This is directly born out of some of the discriminatory practices, especially also the HMDA reporting requirements to pursue unequal outcomes and inequities in lending. So I think there's, in the paper, the Aronson et al. Paper, they look to this as at least consistent. The timing is consistent with these declining effects of the redlining practices, but they can't point directly to them. But I think it does give us some hope that we've made some progress, but much more remains to reconcile some of this history. All right, from Joshua, I'm not sure if this is a conversation 1 or conversation 2 question, but has any of your research looked on the impact of labor unions on the racial wealth gap? Bill Spriggs has done a lot of research in this area, so I'll point to him as kind of the preeminent scholar. I think he has found, in effect, that unions are helpful in terms of leading to more comparable outcomes, although I can't say for certain to what extent that is. But I would recommend his work as an excellent source of the effect of unions on some of these inequities. Let's see. Conversation 2, policies that were implemented in other countries or in US states. I can't recall. I know there's desegregation efforts in California. There's research that is attempting to isolate what is the exact proportions that lead to the most benefits. And I think we're running low on time. So why don't I leave it there? Because I could talk your ear off.
All right, awesome. We will save off the chat and see if we can address anything that's remaining. But thank you, Lowell. I really want to thank you for being here. This was an awesome presentation, super needed. We're really grateful to have you. So,
well, thanks for having me, Jennifer.
You bet. Good to see you again.
You too.
Up next, we have a break. Everybody probably needs to go to the restroom and grab some water.